What could happen if you invested just $100 per month into JEPI? $100 may not sound life-changing, but when it is invested consistently, the distributions are reinvested, and the money has decades to compound. The result becomes much larger than the amount you personally contributed. In this video, we will explain what JEPI is, how it works, review its history, and estimate what $100 per month could potentially grow to after 10, 20, 30, and 40 years. Disclaimer: I am not a licensed financial professional. This video is for educational and entertainment purposes only. JEPI is the ticker symbol for the JPMorgan Equity Premium Income ETF. JEPI is actively managed. This means a management team selects the stocks and adjusts the portfolio instead of simply copying an index. Its goal is to provide income while leaving some opportunity for the investment to grow. As of June 30th, 2026, JEPI held approximately 129 investments. Some of its larger holdings included companies such as Apple, Nvidia, Alphabet, and Johnson & Johnson. What makes JEPI different from a basic stock market ETF is its option strategy. The fund uses investments called equity-linked notes, or ELNs, which contain call options. In simple terms, JEPI gives up part of the stock market's potential upside in exchange for receiving option income. Think of it as renting out part of the future growth of the portfolio. The rent creates income today. But if the stock market rises very quickly, JEPI may not receive that entire increase. That is the fund's main trade-off. JEPI is designed more for income and lower volatility than for capturing every bit of growth during a powerful bull market. JEPI normally makes a distribution every month. That money comes from a combination of dividends paid by its stocks and income produced by the option strategy. The amount can change from one month to the next, and it is not guaranteed. The fund also charges an annual expense ratio of 0.35%. That is equal to approximately $35 per year for every $10,000 invested. JEPI, launched on May 20th, 2020, from its launch through June 30th, 2026, a hypothetical $10,000 investment with all distributions reinvested would have grown to approximately $18,956. That represented an average annual return of about 11%. However, JEPI only has about 6 years of history. That period included the pandemic recovery, high inflation, changing interest rates, and several unusually strong years for large technology companies. Its early performance should not be treated as a promise of what will happen in the future. JEPI gained approximately 21.6% in 2021. In 2022, it lost about 3.5%. That was still a loss, but the S&P 500 fell more than 18% that year. JEPI therefore experienced a much smaller decline. JEPI then gained roughly 9.9% in 2023, 12.6% in 2024, and 8.1% in 2025. Those were positive returns, but they were considerably lower than the S&P 500 during the same strong market years. This demonstrates the trade option. Income can soften some market declines, but it can also limit returns when stock prices rise rapidly. As of June 30th, 2026, JEPI's 12-month rolling yield was approximately 8%. But an 8% yield does not mean the portfolio will grow by 8% every year. Some of the investment's total return is paid to shareholders as distributions. Both the yield and JEPI's share price can change over time. Now, let's look at what could happen if someone consistently invested $100 per month into JEPI. For this projection, our investor starts with $0 and contributes $100 at the end of every month. While building the account, every JEPI distribution is automatically reinvested. This means each payment is used to purchase additional shares, which can then generate additional distributions in the future. We will use a conservative average annual total return of 6% after the fund's expenses. Total return includes both changes in JEPI's share price and distributions received from the investment. This means we are not adding JEPI's distribution yield on top of the 6% return. Doing that would count part of the investment return twice. To estimate the potential monthly income at the end of each scenario, we will use an 8% annual distribution. That does not mean JEPI will always pay 8%. Its distribution changes throughout the year and could be higher or lower in the future. The monthly income figures represent what the investor might receive if they stopped reinvesting the distributions at the end of the scenario and began taking them as cash. These estimates are before taxes and inflation. After 10 years, the investor would have personally contributed $12,000. With an average 6% total return, the account could grow to approximately $16,400. At an 8% distribution rate, that portfolio could produce approximately $1,310 per year. That works out to around $110 per month. In other words, after investing $100 per month for 10 years, the portfolio could potentially begin paying back slightly more than $100 per month. After 20 years, the investor would have contributed a total of $24,000. The projected portfolio value would be approximately $46,200. At an 8% distribution rate, the portfolio could produce approximately $3,700 per year. That would equal around $310 per month. The investor would now be receiving approximately 3 times their original monthly contribution. After 30 years, the investor's total contributions would equal $36,000. The account could grow to approximately $100,500. At an 8% distribution rate, that portfolio could generate approximately $8,040 per year. That equals around $670 per month. The investor contributed only $100 per month, but after 3 decades, the portfolio could potentially provide several $100s per month in income. After 40 years, the investor would have contributed a total of $48,000. However, the projected portfolio value could reach approximately $199,100. At an 8% distribution rate, the portfolio could produce approximately $15,930 per year. That works out to around $1,330 per month. The investor contributed $100 per month, but the portfolio could potentially produce more than 13 times that amount in monthly distributions after 40 years. Notice what happens as more time passes. During the first 10 years, most of the account consists of the investor's own contributions. During the later decades, more of the portfolio comes from investment returns and the reinvestment of previous distributions. That is the power of compounding. In the 10-year example, the investor contributes $12,000 and earns approximately $4,400 in additional growth. But in the 40-year example, the investor contributes $48,000 and receives approximately $151,000 from investment growth and reinvested distributions. The monthly contribution never increased. Time created most of the difference. It is also important to understand that the monthly income amounts are estimates. JPI's distribution is not fixed like the payment from a savings account. The amount can rise or fall depending on stock dividends, market volatility, option premiums, fund performance, and decisions made by the fund's managers. The portfolio value could also be higher or lower than these projections. Still, the examples demonstrate how a relatively small monthly investment could eventually create a meaningful source of income when the distributions are reinvested and the investment is given enough time to compound. JEPI is still a stock investment. Its share price can fall, investors can lose money, and its monthly distributions can increase or decrease. The option strategy may reduce some volatility, but it does not protect the fund from every market decline. JEPI may also underperform a traditional broad market fund during long periods of strong market growth. That is because the fund exchanges some of its potential upside for current income. This does not automatically make JEPI a good or bad investment. It means the fund was designed for a particular purpose. Someone who values monthly income and somewhat lower volatility may find JEPI appealing. Someone whose main goal is maximum long-term growth may prefer a different investment or may decide to use JEPI as only one part of a diversified portfolio. The main lesson is not that JEPI is guaranteed to turn $100 per month into nearly $200,000. The lesson is that a small, consistent investment can become meaningful when distributions are reinvested and the money is given several decades to compound. Before investing, make sure you understand what the fund owns, where its income comes from, and why that income can limit some potential growth. Thank you for watching. Comment below for what ETF you would like me to take a look at next. Subscribe for more beginner-friendly investing content.